Hey folks, welcome back. Hope you're doing well. I'm a little bit under the weather today, but I'm going to continue making videos regardless. Today I want to talk about dividend growth and why you can't use dividend growth to predict stock prices or even dividends. And there's nothing wrong with using it in conjunction with other screening tools, but you certainly don't want to use just dividend growth. And what you're going to see in this video is that sometimes companies will really increase their dividend, and shortly thereafter, the stock just completely collapses and falls apart. And so I've got a couple case studies today: Target's, UPS, General Mills, Best Buy, Pepsi, American Eagle Outfitters, Simon Property Group. And I'm going to start with, I'm going to start with American Eagle Outfitters. It's one that has left a bitter taste in my own mouth because I actually bought this stock in 2018, wrote it up to up 30%, and then it just collapsed. Luckily, I got out of it and I didn't lose very much money. This was when I was kind of a beginner stock picker. I'm going to put up these charts and then you can check out what I say here, okay? So in December 2018, American Eagles, they increased the dividend 10%, and then the stock went down 38%. December 2021, they increased the dividend once again 31%, and then this is followed by a 50% drop. Now this is after COVID, by the way. March 2022, they have increased the dividend once again, and the stock continues to collapse. April 2023, they cut the dividend and the stock rallies over 100%. So here you see the opposite occurring, which is they cut the dividend and it made the stock price just swim up. April 2024, they have brought back the dividend 25% up. Now the stock has fallen 13% or more. So if you had picked this stock because of only dividend growth, you'd have lost a lot of money. You're almost better off picking this stock according to dividend cuts. Not only did you lose dividends, but you had capital loss. And the dividend, by the way, is still not at the level it was in December 2018 when I first bought, actually. That's when I first bought. I think I bought right before the new year, like December 30th of 2018 or something. So American Eagle Outfitters, this is not a stock you want to buy based on dividend growth, okay? Next stock, UPS. February 2022, they increased the dividend 49%. The stock goes down 52% as of from then till now. This is not counting the dividend payments. It's just price, right? February 2023, they increased the dividend 6.6%, and now it's down 40% from that time period. Now the dividend has been growing only by 0.6%, almost no growth. Despite the dividend growth that was in the stock just completely collapsed and fell apart because of the whole Amazon stuff, of course. You still have income, but here's my prediction is I don't think you're going to have income for very long. This dividend is not well covered by free cash flow or the EPS. I give it a year or two at most, and this thing is going to have the dividend cut. Kind of the preface of this video is going to be watch out for these huge 20-30% dividend increases. It is often the company getting ahead of themselves, and then this kind of thing with UPS follows suits. I'm not saying that the dividend increase was why the stock fell apart. I'm just saying it didn't help matters, and people got, quote, maybe tricked into buying the stock because of this. Best Buy, March 2021, they increased the dividend 27%. March 2023, you begin seeing this dividend growth to slowly dropping, and now the dividend growth is only 1%. This dividend is also, it's covered by the free cash flow, but not well covered by the EPS. The stock has completely collapsed. This is one I got lucky on. I bought it as a dividend grower, and somehow I managed to get out of it by pure luck, and I made some money, not much, but it soon collapsed, okay? And it just had a horrible, awful earnings report, by the way. And you can go look at this stock's books, Best Buy. Their books look really awful right now. I would not, personally, I would wait till they turn it around. It doesn't look good. Next one, Pepsi. June 2023, they increased the dividend by 10%. Months later, the stock collapses. Revenue growth has collapsed. EPS is down. The dividend is not well covered by free cash flow. It doesn't look as awful as Best Buy or something like that, but the PE is 19, and so I think this is a hard avoid. I don't think enough people are talking about the ability to pay the dividend. Everybody thinks it's very safe. I've even seen some very respected websites that say the dividend is safe. Maybe I'm missing something, but I don't characterize this as very safe at all. You might be looking at 2 to 3 years, maybe, and it might have a dividend cut. Who knows? Starbucks. Dividend growth has been decreasing every single year for who knows how long now. 89% payout ratio. The dividend is not well covered. Revenue is down, EPS is down, and margins are down. This is another one. Avoid it. As far as I'm concerned, it may be 2+ years before they cut the dividend, but if they don't turn things around, this is another one that's going to get cut. Once again, you could say, oh, well, they increased their dividend, let me buy this stock. It was a bad idea. General Mills, one that I know a lot about and one that I have gotten super lucky on. I bought it in December of 2018 when there was almost no dividend growth, and I sold in 2019 and I made out like a bandit. And then this stock, of course, has since collapsed. So July 2022, they increased the dividend 6%. 6 months later, the stock crashes. They increase it July 2023, 9%. It's still falling. The dividend is well covered, but it's not growing. It's not keeping up with inflation, 1.7% growth. So you're losing to inflation with the dividends and the capital appreciation. Right now, this stock looks awful. It looks like a value stock, but I am not buying it. Target, August 2021. This is an example of a company seriously getting ahead of themselves. 31% dividend increase, red flag. The stock collapses within a few months. August 2023, Target stock has almost no dividend growth, like 1.82%. This dividend is covered, but this is dangerous because you are potentially losing purchasing power. Out of all the ones that I've told you so far, maybe Target's is the safest dividend in my opinion, okay? But at 1.82% dividend growth, you're going to be losing purchasing power if this stock price does not rally. Next one, Simon Property Group. This had an actual dividend cut. It averaged 5% dividend growth a year before COVID, and then of course it just got completely cut. I bought this one after the dividend was cut. The price has only now recovered back to what it was pre-COVID. And you almost 1 year of no income with Simon Property Group, okay? I think I bought in 2020 and sold in 2021. Once again, I got lucky. 5 years later, your dividend is basically what it was before COVID. So, you could have bought more shares, but your dividend did not increase since the pandemic. And the price is, if you traded the stock, you made out like a bandit. But if you buy and hold here, you didn't do all that great the last 5 years. The dividend is not that greatly covered by the free cash flow as far as I'm concerned. It's okay. It's not horrible. These are just good examples of stocks where if you go into this just only buying because of dividend growth, you're going to potentially put yourself at great risk. So I don't like the way some people talk about dividend growth as like some flawless approach to investing. They'll say, well, avoid high yield and only buy dividend growers. Well, you can see what that can happen. So here are some conclusions. Dividend increases, very, very large ones, are often followed by years of no capital appreciation and potential losses. So be careful. Sometimes I wonder if this dividend growth is like some attempt to prop up the stock and make people buy it, and so people, insiders can get out or something. Dividend cuts sometimes is a great time to buy, despite what you may think. If you see a stock with regular decreasing dividend growth, like a good example would have been Medical Properties Trust, it was pretty obvious to get out of that before the dividend was cut and so forth. I warned people to get out of that stock a long time ago. The last conclusion, potential dividend cuts, in my opinion, American Eagle, UPS, Best Buy, Starbucks and Pepsi's, maybe a while, but potential. Simon Property Group, another potential. I think the ones that are okay, General Mills and Targets, but you may not keep up with inflation by buying these things. This is an example of when shareholder rewards turns into punishment. Management has irrational exuberance and the shareholder suffers for this. So be careful out there when you just follow these kind of strategies mindlessly. Always look at things like return on equity, revenue growth, margins, look out at the cash flow payout ratios, and look how companies within the sector are doing as well. All right, you all take care, and hopefully this has helped you out some.